Hey, welcome to The Explainer. You've probably heard all the chatter about the Federal Reserve, right? Well, the big question on everyone's mind is what happens when they finally decide to cut interest rates. So today, we're going to break it all down and give you a clear, actionable game plan for exactly that.
So let's just cut right to the chase. When the Fed makes a move, you feel the ripples everywhere. I mean, from your credit card to your investment portfolio. But how does that actually work? And more importantly, how can you be ready for it? Well, that's what this explainer is all about.
All right, here's our playbook for today. We're going to start with the big picture, the overall game plan. Then we'll dive into three key areas to get the biggest boost: growth stocks, what I call the income plays, and of course, the spending boost. And then we'll wrap it all up with some final takeaways to make sure it all sticks.
Okay, first things first. Let's build our game plan by really setting the stage for what a rate cut actually does to the economy.
You can think of a Fed rate cut as someone hitting the gas pedal on the economy. It's like injecting a bunch of fuel into the engine, but not all parts of that engine get an equal boost. Our job here is to figure out which sectors get supercharged so you know exactly where to look when that green light starts flashing.
First up in our spotlight, growth stocks. You know them. These are the innovators, the tech companies, the companies whose value is tied less to what they're earning today and way more to their massive potential in the future. So why do these stocks just love rate cuts? Well, it really boils down to this one core idea. Future profits are worth more today when interest rates fall. See, lower rates shrink the discount on those future earnings, which makes a company's 10-year plan look a whole lot more valuable right now. It's why they're called long-duration assets. They're just super sensitive to any changes in that long-term outlook. And of course, cheaper loans mean more fuel to expand even faster.
And we're talking about giants here, right? Like Microsoft and NVIDIA leading the charge in AI, or Amazon in cloud computing. Now, a quick but really important note. These are just examples to make the idea stick. They're here for illustration, not as any kind of investment advice.
Okay, so if growth stocks are all about what's coming tomorrow, our next group is all about reliable income today. Let's put a spotlight on the companies that investors flock to for steady payouts, especially when a rate cut makes other options, well, kind of boring.
And this brings us to this really key phenomenon called the search for yield. See, when the Fed cuts rates, those super safe places like bonds and savings accounts start paying next to nothing. So investors, they have to start looking elsewhere for a decent return, or yield. And that search often sends a wave of money toward two specific areas.
And one of the first places they look is real estate investment trusts, or REITs. The easiest way to think about REITs is as giant landlords that own and operate pretty much everything: shopping malls, apartment buildings, even healthcare facilities.
Now, REITs get this fantastic one-two punch from rate cuts. First, real estate is a business that's built on borrowing money, so lower rates directly slash their biggest expense, which is great for profits. And second, and this connects right back to that search for yield, REITs have to, by law, pay out most of their income as dividends. So when bond yields are pathetic, the high dividends from REITs suddenly look incredibly attractive. This space includes companies like Realty Income, which focuses on retail properties, and Welltower, which is all about the healthcare space. And just like before, please remember, these are just examples to help explain the concept.
The other major income play is the utilities sector, and investors often treat these companies as a sort of bond substitute. So why is that? Well, let's just compare them. As you can see, when rate cuts make bond yields fall, the nice competitive dividends from stable utility companies look way more attractive. Plus, unlike a bond with its fixed value, utilities also give you the chance for the stock price to actually grow.
I mean, these are the companies that are literally powering our economy. For a lot of investors, they become a bedrock for income when the Fed starts making moves.
All right, for our final spotlight, we're moving from Wall Street to Main Street. It's all about the direct spending boost that comes from, well, you. We're talking about the consumer discretionary sector, the companies that sell the wants, not just the needs.
When the Fed cuts rates, it's pretty simple, right? Borrowing gets cheaper. That means lower payments on everything from car loans to mortgages, and that directly frees up cash in people's pockets. And when people have a little extra cash, what do? They often spend it on those bigger things they've been putting off.
And what's really interesting is how diverse this sector is. It covers everything from Amazon and online retail and Home Depot for home projects, all the way to travel giants like Marriott and Royal Caribbean. All of them are positioned to benefit when lower rates make people feel a little more confident and maybe a little bit richer.
Okay, let's bring it in for a final huddle. We have covered a lot of ground, so let's boil it all down to the most important points from our game plan.
So here are the three big things to remember. First, the Fed is always doing this balancing act, right? Juggling inflation on one side and employment on the other. Second, those rate cuts act like a catalyst. They hit the gas on the economy and often for stocks. And third, now you know the key groups to watch: high-flying tech, the steady income plays like REITs and utilities, and those consumer-driven spending stocks.
But before we wrap up, there's one last really crucial piece of perspective. While the Fed is a huge player, it is not the only player. Things like how well a company is actually run, what's happening around the world, all of that plays a massive role in where the market goes.
So, what's the most important takeaway from all this? Well, understanding these cycles is an incredibly powerful tool, but it's not a crystal ball. The smartest strategy, no matter what the Fed is doing, really does stay the same: building a diversified portfolio and keeping your eye on the long term.
So the next time you see those headlines pop up about the Fed, you'll have a playbook. You'll have a framework to understand what's really happening behind the scenes. The only question is, how will you use it to view the next economic cycle? Thanks so much for watching.